Hello, I am Michelle Soriano, president of Castle Rock Investment Company, and today I've got the third quarter review of Castle Rock PEP for you. Go ahead and share my screen. It is Halloween, so I'm sorry it took me so long to get this report out to everybody. So we'll go through the context, the 2025 limits, make sure you're saving enough, some updates, my thoughts, water cooler wisdom, and the investments. So jumping right in, you know about Slavic as the pool plan provider on the investment advisor. If you're not familiar with payroll integrations, they are just that 360 integration between uploading payroll contributions to Slavic. They work with practically every payroll provider out there. I use them personally just because I want to reduce my workload. So if you want to outsource contribution file uploads, please reach out to Amanda. 2025 limits, as you know, 23,500, then the catch-ups and super catch-up if you're of a special age 60 to 63. Some quick updates. So as you know, we had an investment change of the emerging market fund in August. We'll discuss that more. Payroll integrations that I mentioned. I want you to check out the community page. I uploaded a lot more resources and I'm going to continue to update them. So there's so many free tools out there, right? And we've got free financial planning software that I provide to you. Sign up for a one-on-one meeting with me. And there's so many tools, so I try to group them all by subject matter, so you can, kind of pick the topic that's most interesting to you, and then in that drop down, lots of free tools for you just to look at. And I'll keep updating this site, but I wanted you to look at that, and then the last part at the bottom, the community challenge starts January 1st. Now, we haven't started it yet, so please give me your feedback. What I'm trying to accomplish is just for us to just be inspired with a little peer-to-peer competition to learn more, save more, make money, have fun, and then the winner being the business spotlight at the top of the community page. So Bob Willick has been able to have that top billing so far. So if you want your business spotlighted, join in. I'm going to add a leaderboard. But if you've got feedback regarding how to earn points or if we should change it up, please let me know. I'm more than happy to do that. All right. And then moving on. So water cooler wisdom. You know all these numbers, unemployment rate, everything's pretty stable. It's really Goldilocks. Market had huge returns. CPI is 3, unemployment rate's 4.3, and even the Fed funds rate actually just dropped 0.25% a couple of days ago. So very Goldilocks. Of course, price earnings ratio well over our 20-year average. But this past week, we also had super strong earnings coming out of pretty much every industry, every company. An unusual area, as you know, the top 10 companies making up almost 40% of the S&P 500 is unusual. So a lot of our money, if you invest in the S&P 500, a lot of our money is in these 10 companies in particular. Now, AI is all the rage, right? I'm even using AI. I'm a dinosaur. So this is looking at what percentage of folks were using AI in September of 2023 versus September of 2025. It's fascinating how much that is taking up of our time. So last quarter, as you know, I was a dog and a bone regarding student loan debt. So we've got that, and now we've got the expiration of the ACA tax credit. So I asked ChatGPT, what's going to be the impact? Now, the student loan debt, I wanted to show you, it is finally showing up on the reports, because before it was just kind of a ghost debt, but it is showing up now. So of the folks that are going to have their pay garnished, ChatGPT actually did wrong numbers. In the end, in big picture, it was right. It just wasn't precise right. So I had to do this by hand. But basically, we know their general income, and if we use an estimate on that, and then use their gross pay minus taxes, that's their disposable income, the 15% garnishment, we get an estimate on the reduction of take-home pay for 2026, about 24 billion on that first set of 5 million. And we know there's another 4 million following that, but just we'll start with this. Then the reduction or elimination of the ACA tax credits, what that's going to mean, because we know we have some good data on how many folks were receiving that, what the cost was, and averaging that out per employee or enrollee. So with that, with the 20 million people that are impacted, reduction in consumption of 11.3 billion. So looking at our consumption here, which is the majority of our GDP, within a $32 trillion economy, what does it mean? Nothing. Doesn't matter. No big deal. So even with all that 35 billion together in a $32 trillion economy, impact to GDP would be like 0.1%. So yeah, consumers in the top 10% of income in America literally consume, they make up 50% of consumption in America. The top 10%, they make up 50% of consumption in America. So this little $35 billion blip, no big deal. All right, so Wilma is going to loosen her grip. So this is a really conservative economic think tank, I would say. According to them, yes, the first quarter will be a little bit of a slowdown. That's expected. So it's going to be felt kind of across the board, but pretty Pollyanna-ish afterwards after that. So second quarter, third quarter, fourth quarter, all looking just darling again. The one other thing I did want to show, which, you know, I'm just like that, type A, total non-farm employees. So this is how many jobs are we creating in America? How many jobs are we creating? So we have less people here. Everybody knows that. But we're not creating a lot of jobs. That's this last line here. So you can see in red the total destruction from the 2008 financial crisis. You can see the destruction from COVID. We don't have that same kind of thing happening here. It's just crickets, right? Like nobody's making a lot of jobs right now. So something to think about. Investment review. The qualified default investment alternative is going to continue to be the Vanguard target retirement funds. Qualified default, this is all ERISA lingo for you. Shockingly, you are in an ERISA plan, but you don't have to know anything about ERISA. That's our job. But I did want to tell you that this glide path, everything that's underlying it, they're all index funds. So you can see below, they're all index funds. That's why the expense ratio is 0.08% because it's all index funds. You're defaulted into the year fund that is closest to your 65th birthday. You don't have to stay in it. You can change it to anything you want, but that's what the default is. And the reason why is because we're falling and we're using the protection of, it's a safe harbor inside ERISA called ERISA Section 404C5. Again, you don't need to know that, but it's important because this is what we're using. If you say, why do we do this? This is why. Because oddly enough, only lawyers can write language like this. In the last sentence, it says, as a result of this deemed participant exercise of control. So you were automatically enrolled. You were automatically put into this fund. The way they wrote the law, it was as if you exercised control and did that on your own. Plan fiduciaries will not be responsible for any loss or breach that result. That's the way the law is written. I'm not a lawyer, so don't ask me how to explain how you exercise control when you were defaulted, but that's the way they wrote the law. So that's why we do certain things. And you're going to get a lot of notices before Thanksgiving. So these are all the required notices for all the different groups of folks. And again, it's all from the laws, and that's why. So I want to point out a little thing, not a big deal, kind of a big deal, not a big deal. Vanguard, for the money market account, the portfolio manager suddenly changed the week before the quarter end. The portfolio manager who had been there forever and ever retired suddenly, and there's a new portfolio manager. That doesn't happen normally. Normally, retirements are planned in advance, like a year in advance, right? So this was just unusual, so I had to just note it to you. As you know, the Artisan Fund replaced that GQG emerging market fund. Thank goodness, because if you just even look at what happened in the third quarter on that 3-month performance, I'm going to do a separate recording and report on the new fund. I I'm glad I have another meeting with them next week, and so I want to get a couple questions answered and get you that summary on that new fund. There is one more fund, though, I do want to replace. So this MFS fund, the International Equity Fund, they, which is normal, back in May, announced that this long-term portfolio manager is going to retire next June. Great. So they took a co-manager of an emerging market fund to work with this portfolio manager for the year together before taking it over. The fund has been tanking since that co-manager joined. And I don't think I want to wait until the long-term portfolio manager retires. I think I just want to replace it. With performance like this, I don't think we need to wait a whole lot longer to see what this new co-manager is going to keep doing. So that's kind of the setup on this fund. The gold rating was as of September 11th, which is surprising because the co-manager has been working with the current manager since May. So I'm surprised that it maintained a gold rating because the performance is horrendous. The rest of it shows performance. I'll just go through one, just so you know how to read the report. Vitality 500 Index Fund, jump over to the performance 8.12, year to date 14.8, 1 year 17.59. And what is in parentheses is the ranking versus its peers. Top 21st percentile. On the 3 year, you see top 22nd percentile. 5 year, top 20th percentile. I'm happy. Anything like 50 to, 1 to 50, great. But things happen. You can see the Vanguard Midcap Index was 51 on the 5 year. That's a blip. That's not going to be a problem. You can see the 1 year is at 13th and 3 years at 22nd. So next quarter, that 5 year is going to be in the top 1 through 50. So past the performance, there's a couple items in the appendix I'll point out if you have trouble sleeping. I did put in the standardized investment performance. This is the way the government wants you to see investment performance. I think it's better to see investment performance compared to peers, but this is how the government wants you to see it. And then beyond that, I have the FI360 score methodology. So when you see those numbers and the greens, the yellows, reds, all of that, this is the methodology behind it. So that was it for the third quarter review. Thank you for your time. Happy Halloween. I hope you have a great weekend. And please check out that community page and please give me your feedback. I'd love to hear what your thoughts are. Thank you for your time.